This week in tech. So the US just had the second largest bank collapse in US history. And so this is going to be the only story I cover. So this week in tech is usually 3 stories. There is no way I can crunch this story down to a minute. We got to break down the timeline of how this even happened. Silicon Valley Bank, the 16th largest bank in the US, was seized by federal regulators because, the bank has failed and it has to try to sell some of the bank's assets to get some money back to SVBs depositors. And so this is kind of causing this scare of, where people should keep their money. And there's going to be tech companies that can't cover their payroll this pay period. Got to air it out because I want to educate, not just blurt headlines at you. I want to educate you on why this is even happening. So to start, Silicon Valley Bank's main, clientele, main customer are tech companies, tech startups, and venture capitalist firms. Because, it's Silicon Valley. So a perfect storm happened that it began with the pandemic. During the pandemic, all these companies generated all this money and it caused a surge in deposits at Silicon Valley Bank. And so Silicon Valley, I'm gonna just say SVB. SVB bought tens of billions of dollars in seemingly safe assets, things like treasuries and government-backed securities. And although these securities are no risk, these securities are also on a fixed interest rate, and some of the more financial literate might know where this is going already, but I'll get to it. So during this influx of cash that tech companies were getting during lockdown time, that just enabled more burning cash and less actually putting deposits in the bank. So there was more going out than coming in. So SVB, they had to attract new deposits, but that was also costing them more money. And all this is happening at the same time where federal interest rates are hiking up dramatically. And this hike happened as a cause and effect to the rates being dramatically lowered during hard times to kind of encourage some economic activity. No, we weren't spending anything. Now, like I said before, those securities are on a fixed interest rate. And when they got these securities, they were at a much lower interest rate than rates are now. And so Silicon Valley Bank's only choice was to sell those securities at a loss. So the securities were worth $21 billion. Whenever they sold them, the loss was $1.8 billion. So they wanted to fill that gap. Silicon Valley Bank's plan was to simply raise more money to fill in the $1.8 billion gap that they lost from selling those securities under the new higher interest rate. And that all sounds bad, but real talk, everything was actually still fine at this point. The company was still liquid enough to have enough to still be a bank, you know what I'm saying? Had plenty of cash available. And then Silicon Valley Bank announced that they were going to be raising some money to strengthen its balance sheet. The reason that was a problem, the last thing a depositor of a bank wants to hear is that the bank that their money is in is having to raise money. So what's going on? And so Silicon Valley, they tried to reassure customers, but again, if you're a depositor having to be reassured about anything, you're like, I don't feel like my money is safe. Following this, businesses scrambled to this bank to flush their money out. People were withdrawing like a mother. And this is already after companies are already taking huge deposits out to fight back against interest rates and inflation to stay afloat. And a bank isn't a bank without any money in it. It's not a bank anymore. So reassuring your customers as a bank becomes a psychological issue with your customers. And now people are concerned that it could happen at other banks, especially considering there's been these episodes of people's money just disappearing or deposits and paychecks just not hitting accounts. And one of the big takeaways for both people and businesses is that the FDIC only covers $250,000 no matter how much is in that account. That's your assured amount, $250,000. But this bank has money from companies like Apple and Roku and who else? Roblox. They have a lot more than $250,000. That's why these assets have to be sold, and that's why this bank got shut down. And it's being sold to somebody else or something. And some experts say they have faith in the FDIC that they'll make things right again. They'll get the job done. We'll know for sure next week when so on Monday they'll be making that $250,000 at least the insured amount available to these companies. I'm pretty sure even if those companies did have money in several accounts, I'm sure there was still a lot in the Silicon Valley Bank account. So after this, I have 2 things I think could be taken away from this, and I'm also not knee deep in finance. I'm not a financial guy. This is just I observe something, maybe it's common sense, But one, it sounds like you shouldn't be putting any more than $250,000 in one account. If you got more than that, you should be starting another account where that amount is also insured by the FDIC. And number two, it could be an accountability thing, but why do businesses and individuals have the same cap for FDIC insurance? Because like me as an individual, I'm probably not gonna have like payroll and overhead fees, but a business will. The only way I can think of, it's like, hey, you better organize your business and finances right. Maybe it's like customer protection. I don't know. It just feels a little bit weird that people and businesses would have the same amount insured. And so anybody wondering where this huge headline came from, this bank crashing in 48 hours, coming from someone who's not, I don't know, a financial guru, that's not my world. That's the simplest way I can kind of put the timeline on how we got here in the first place. The story is still developing, so yeah, we'll see how this thing turns out. Until next time.